I'm also an owner in the Empire State Building. So I was going up the Empire State Building with my family about a year ago, and I said, "Hey, I'm an owner," and they all looked at me like I was crazy. Just like we do with real estate, you make money when you buy. Well, it's the same thing with stocks. You make money when you buy. Just like private real estate, REITs, it's important to just look at this as a long-term game. It's not just we're not talking about flipping houses and making millions of dollars. That's kind of a get-rich-quick scheme. But there's a requirement by law, again, going back to 1960, this was part of the original law, that REITs must pay out at least 90% of their taxable income to investors in the form of dividends. So I think it's very, very much, we like the safe haven stocks, what we call the swan stocks. Stands for it's sleeping well at night. The most important decision you're ever going to make is not your first job, it's not your first house, it's
Hi, everyone. This is Jack Allwild with another money episode. Today, we have very special guest, Brad Thomas from Wide Moat Research. You can find them at Wide Moat Research on YouTube, and he is literally the author of REITs for Dummies. Brad, welcome to the show.
great to see you, Jack. Always love to talk about real estate, so happy to be on the show.
So, before we get into real estate and what a REIT even is and the mechanics behind it, I do like to ask everyone, what was your relationship with money like growing up?
Well, Jack, that's a great question. I was raised by a single mom, so hardworking single mom. So at an early age, I learned the importance of earning money. That's the offense we talk about in The Millionaire Next Door, which is a great book. Later in life, I learned about defense. When I became a real estate investor and developer, really right out of college, ended up, building a lot of buildings, and I learned I guess, the hard way. The game is won by not only making money, but saving as much as possible. And really, that's what I'm focused on today. Kind of my reincarnation, which occurred in the Great Recession in 2008 and 2009. Some very difficult times, but I learned the importance of both not only earning money but saving money.
Have there been any tools or books in particular, resources that helped you kind of change your mindset to really focus in on saving?
Yeah, there's a really important book, and actually, I lecture at a lot of universities. Last week, I was at Clemson University. Frequently lecture at Penn State and Cornell and NYU and some other schools, and I always tell these students, probably the best, most important book I've ever is called The Intelligent Investor, written by Benjamin Graham. It's not necessarily a real estate book; it's an investing book, but that really, again, taught me the principle of saving money and really buying companies that are on sale, just like we do with real estate. You make money when you buy. Well, it's the same thing with stocks. You make money when you buy.
Awesome. So, getting into the guts of the conversation, you did write REITs for Dummies, and for a beginner out there, like myself, when it comes to REITs, so can you describe what a REIT is, and can you get into some of the pros and cons compared to directly owning real estate?
Yes, actually, last week I wrote an article on White Moat Research. You can read the article there at whitemoatresearch.com, and I actually talk about the differences of private versus public real estate, or REITs, publicly traded companies, or real estate investment trusts. So I write about the advantages and disadvantages. So first of all, let's talk about some of the advantages for REITs, real estate investment trusts. This particular asset class was formed in 1960 during the Eisenhower administration. So they've been around a long, long time. So it's very proven, stable business model. And one of the differentiators, of course, is they're publicly traded, which means they have liquidity. So unlike private real estate investing or rentals, in the public space or REITs, you have liquidity. So these companies are traded on the stock exchange, which is great because you have SEC compliance. These companies must report earnings to investors and provide shareholders with a lot of detail. So there's a lot of transparency as it relates to REITs because, again, they're publicly traded. That's a requirement with the SEC. The other part of that liquidity, of course, is you can sell those companies or those real estate stocks anytime. So when you sell a private property, of course, you've got to go hire a broker, find a buyer. The buyer has to find the lender. So it takes several months to really get to a monetization point with private real estate. With REITs, you just click a button and you can sell a share, or you can click a button to buy a share. So liquidity is definitely one of the most important attributes. Now, one of the most important attributes for private, of course, is the lack of volatility. So again, there's a trade-off you have between something who's liquid and is more volatile, because the stock market prices go up and down, on a daily basis, or really on a every second. The stock prices go up and down. So it's important to understand the differences. If you don't want that volatility, um, you have access to sorry, you have access to many different companies, and another big part of the REIT sector versus the private sector is that there's a lot more diversification. So, Jack, when I was in private real estate, I primarily built shopping centers and freestanding net lease properties, so I knew how to get access to those types of properties because I built them. However, in the REIT space, you can now own shares in practically any type of a property sector or subsector. For example, I'm a shareholder in MGM and Caesar's Palace. I'm actually I tell my kids when I go to Las Vegas, I'm an owner, which I am a fractional owner in Caesar's Palace and MGM and many other casinos around the country. I'm also an owner in the Empire State Building. So I was going up the Empire State Building with my family about a year ago, and I said, "Hey, I'm an owner," and they all looked at me like I was crazy. But I explained to them, that I'm a shareholder in the REIT that owns the Empire State Building. So having access to all these different sectors, data centers is certainly a great place to invest right now with all of the demand with artificial intelligence. I can never go out and invest in a data center on my own on the private side, but certainly in a REIT format, you can own data centers, or you can own cell towers, or you can own manufactured housing in Florida. So there's just a very large and growing marketplace for publicly traded real estate. And I think the most important attribute, kind of differentiating again the private versus the public real estate investing, is the fact that REITs pay out dividends. So there's a requirement by law, again going back to 1960. This was part of the original law, that REITs must pay out at least 90% of their taxable income to investors in the form of dividends. Now, with private companies, you don't have that same type of governance. You can either, if you're a limited partner, either the general partner is going to pay out distributions or not. They don't have to. There's no like requirement binding them. But in a REIT, these public companies must pay out their investors. So that gives you a very forced dividend, and it's very important for retirees, because many retirees in the REIT space are really looking to own REITs for their dependability of the income. And also the income is high, again, because 90% of that net income has to be paid out dividends. So that's why REITs now, their dividend yields are much higher than ordinary C corporations, almost double. So right now, REITs are yield anywhere from, say, average of about 4.5% probably today in all sectors. But you can have some high yielding REITs or low yielding REITs. There's all types of different ways to invest. So, and I guess I'll close by saying, I would never just own one REIT. It's important to also practice kind of, responsible diversification. But the great thing about building a portfolio of REITs is that you could allocate your capital within certain sectors that are going to provide a better risk profile. So if you want a lot of high growth, real estate, you can invest in data centers and cell towers and industrial warehouses, obviously driven by a lot of these logistics, and the technology within these warehouses today is incredible. So you can invest in these high growth, companies that have the kind of tech plays, or you can invest in kind of the slow and steady dividend payers like these net lease REITs. There's quite a few net lease REITs today, and these net lease REITs are companies that own freestanding buildings that are leased to companies like O'Reilly Auto Parts or FedEx or McDonald's, for example. Long-term contractual leases that pay fairly consistent dividend increases along the way. So anyway, that's the broad look at REITs. And again, it's a great asset class. I would definitely consider, if you own private real estate, you should definitely consider looking at REITs as well.
Mhm. Okay, I'm When I think of real estate, one of the advantages is the tax benefits, and a lot of people, depreciate their properties. So I'm actually like on paper, wouldn't a lot of properties show losses? So how are we distributing when the company's actually showing a loss? Can you kind of talk about the actual value of the property and like I guess the rents coming in and yeah I guess the mechanics of how they have to pay out the 90%. That's interesting.
Well, is it another part of that? You touched on a great point here. Is on the private side, as a private landlord, you have a lot of I guess tax advantages that you would not necessarily have in the public side. For example, on the private side, a lot of my friends that own properties and high net worth investors and family offices, for example, they look to cost segregation, and really bonus depreciation is really important because a lot of their investing has to do with not only about making money, but just principal preservation. So real estate is definitely tax advantage, especially for very high net worth investors who would try to shield money from not paying as much money to the government. Real estate is a great way to do that because you can basically utilize a lot of this depreciation. And again, if you've got really good CPAs who understand cost segregation. If you don't, you should, if you own a lot of real estate and understand the importance of depreciating that and kind of taking earlier depreciation over some of the improvements that are inside the real estate. So definitely cost segregation, bonus depreciation are really important on the private side. They're not as important on the public side. But another tool that's used both on the public side and the private side, which has been around a long, long time, and I'm sure you've you've talked about or had some other guests talking about 1031 exchanges. So certainly that's a tool that again both public and private companies utilize the tool, which essentially, of course, is a way to take those capital gains and defer those capital gains by reinvesting in a like kind property, and always trying to increase your capital gains going forward. Now, eventually, once you sell the property, you don't do a 1031 exchange, then you pay taxes. So it's not necessarily a loophole. Sometimes, people kind of refer to it as a loophole of sort, but it's really not that. It's not a loophole, and that's why it survived multiple political regimes over the years, because it does benefit investors, not just not just big investors or REITs, but just small investors, farmers, and individual duplex owners utilize 1031 exchanges. So those are some definitely tools to use on the private side. And again, REITs don't have the depreciation is not that much of an important part of the REIT space. Most people who invest in REITs, especially retirees or pre-retirees, are really looking for that income. And again, we actually had a show on our YouTube show just a couple weeks ago on the power of compounding. And again, it's really amazing to see when you can just reinvest those dividends back into the shares that you own, and what that portfolio looks like, 5, 10, 15, 20 years from now. So just like private real estate, REITs, it's important to just look at this as a long-term game. It's not just, we're not talking about flipping houses and making millions of dollars. That's kind of a get-rich-quick scheme. We're talking about slow and steady ways to create wealth by investing in these really solid landlords, and of all types of different property sectors.
Mhm. And because I guess the income component is so important to a lot of people that invest in REITs, is it safe to say there are not REITs that are like just vacant land? Or
Yeah.
is that not?
Well,
Yeah.
again, so again, the whole premise for, kind of going back to that law of 1960, I mean, we want to have their income. These are income oriented investments, alternatives. So you definitely want to have that income because again, there's not, I don't know of any like pure land REITs that don't have income. However, there are certainly farming REITs as an example, and they do produce income. That's a great way, another great category to invest in. We also have a number of timber REITs who own land plus the trees, but they generate income as well. So everything in the REIT space is really income oriented. There's no really land only plays. Now many REITs do own excess land for future development. We do have REITs that develop their own portfolios. So some of them have fairly substantial land banks which they can eventually use. For example, one of the casino REITs that we cover is called Vici Properties. That's VICI Properties. That's their ticker symbol as well. And they own a number of vacant land parcels in Las Vegas, which will accommodate a lot of future growth for the company. That's one reason we're extremely bullish in Las Vegas right now, because there's a tremendous amount of demand. All the sports development there, just a number of attractions, just move beyond gaming into more of an experiential opportunity. And so, but they have a lot of land that can be developed, and a number of other REITs have a lot of land holdings as well. But there's no what I would call kind of pure play, just land only REIT.
Gotcha. Okay. So shifting a little bit to like a more of a macro question. So a lot of people are talking tariffs right now. We're wondering, it's price is going to get higher domestically. Things just seem to be slowing down. So are we going to get inflation, deflation? What's the Fed going to do? So can you talk through some of the different REIT performances based on interest rate changes?
Yeah. And I want to say, we've been really pretty vocal lately here at Widemout Research about not only investing in very high quality REITs, but just high quality dividend paying stocks. You're right. There's a lot of volatility. It's a coin toss as to whether or not we'll be in a recession in a few months or stagflation. We haven't seen stagflation since the 70s. But tariffs has certainly created a lot of volatility. Obviously, Trump has pulled back on a lot of the tariffs, but we're still obviously with China and just the uncertainty as it relates to tariffs in general. It created a lot of concern in the market. So I think the key factor here, the two things we're watching very closely, of course, are inflation. Is inflation gonna move back up because of the tariffs or not? Of course, what we'd like to see, I think every real estate investor would like to see this, whether they are publicly traded or privately owned. Real estate owner is we want to see rates come down. It's very hard to pencil out deals, especially on the private side. I'm looking at some deals myself right now, and it's very difficult, especially with debt involved, because we're still seeing fairly elevated debt levels, and a lot of deals just don't pencil out, frankly. So that's where I think from a private side, I think the opportunity is more on just equity or private credit type of capital versus debt. Um, but I will say, I think what we're going to see is eventually rates are going to come down, and REITs have underperformed a lot of their competitors, competing asset classes for quite some time over the last like 2 years. Again, thanks in large part, or due in large part, to the elevated interest rate environment that we're still seeing. But I do think what's going to happen is rates will come down. Of course, a recession, what normally happens in a recession is rates will come down. And so I think we'll definitely see that occur if we enter into a recession. And obviously, President Trump is pretty vocal to the point of kind of shouting names at the Federal Reserve chairman, which has certainly caused that volatility this week, and last week. But yeah, I think that's what we're going to be in. And look, I mean, I think most of the companies, again, that we recommend in the REIT space, as well as the non-REIT space, are these companies that still increase dividends. I mean, as long as you have, growth, dividend growth, and really repeatable dividend growth, that's really the key here for investors, because you can kind of just ignore this volatility. The prices are going to go up and down, but as long as those dividends are still going up, the investors are going to make money. I mean, if you have companies that are going to continue to pay out dividends, in fact, on our YouTube show this week, we're talking about that very same concept. As long as the company is growing its earnings and growing its dividends, the price will eventually follow that. So I think it's very, very much, we like the safe haven stocks, what we call as swan stocks, stands for sleeping well at night. So we want to have those companies that are very high quality, they have high quality balance sheets, they're very diversified. They can really mitigate most any economic condition. We've seen these companies through pandemics now. We've seen them through multiple recessions. We've seen them through great recessions. So even if we enter into a smaller, what I call garden-style recession over the next, several months, many of these high-quality companies that we're recommending are going to be able to sail right through this storm and come out the other side. And that's what investors really need to be thinking about today, is just insisting on the highest quality companies and not trying to just chase yield and buy these companies that aren't sustainable. That's really critical for us.
Mhm. Can you paint any of the picture of like how some of the debt is structured for these bigger deals? And like, is there a lot of maturing debt that is going to be needing restructuring in the next year or two, or how does that shape out?
Yeah, again, this is a great question, Jack. And really part of our research is we want to look hard into the balance sheet, check under the hood of these companies and see exactly, make sure there's no ticking time bombs. So a lot of these companies, we do look at debt maturities. A lot of companies have, have investment grade balance sheets. So they issue unsecured debt. So very different from when I was a developer, where I was just going to the bank and I would, finance these deals on a one-off basis. And they were usually, senior secured loans. With REITs, especially these higher quality companies, they have, access to large, billion-dollar plus unsecured credit facilities, which allows them to acquire the property. Then they can go back in later and kind of match fund the debt. And so they have longer duration debt profiles. And what's happened is what's really interesting. I mean, I'm a product of the Great Recession. When I came to the Great Recession, I had a lot of debt. I had a bad business partnership. I ended up going from way up here to way down here, and it was a big crash for me, and it was a big wake up call. And that's the one of the reasons I decided to become a research analyst to really help educate investors on some of these lessons that I went through. But to the point, a lot of these REITs also had higher leverage going into the recession in '08, '09. Since that time, they've really managed to deleverage their balance sheets and really prepare for more uncertainty. And that's one reason REITs did really well during COVID, by the way, because nobody really anticipated, obviously, what we went through in 2020. So for the large part, these companies have really, balance sheets that are in shape. We don't really see a whole lot of. They've been able to manage the debt maturities, and when they do take on new debt, these investments are accretive and cap rates have adjusted, so that we like to see kind of investment spreads. And that's the great thing about investing in REITs is we can look at the overall cost of capital of the company because they're publicly traded. We can see actually what their debt cost is. We can see what their equity cost is. Again, it's a function of the stock price. And when we look at that weighted average cost of capital for those companies, we can compare that to what they're investing in or what they're acquiring or what they're developing. And whenever we see, investment spreads that are, 100 basis points, 150 basis points, profits above that cost of capital, those are what we refer to as accretive investments. And that means they're able to continue to grow their earnings and grow their dividends. So for the large part, not all REITs, have these like swan-like characteristics. But the ones we do like and the ones we recommend are companies that we just really we're not as concerned about, interest rates in this environment. Now, for the average Joe or the average Jane type of real estate investor, yes, as I said, it's very difficult to pencil out, debt today. And you still see a lot of landlords are still having problems, with getting their loans renewed, especially if you're in sectors like the office sector. Banks aren't really too excited about lending in the office space right now. A lot of the multifamily loans that are coming due are harder to reset, harder to reprice because again, we've got to go from a 2.5% rate to 6 or 7% rate. Makes it very difficult. So anyway, there's still some volatility out there on the private side, but not as much on the public.
Okay. In terms of tools that you use to evaluate REITs, what resources other than your book could you point us to help us do some research?
Sure. Well, we're actually getting ready to launch several monitors at Widemont Research. We'll have available all types of data for publicly traded REITs. Definitely that's a great resource. We use another tool I use a lot is called FastGraphs. Fast stands for Fundamental Analysis Software Tool. A good friend of mine developed this product. I would encourage you to go to fastgraphs.com. A very good friend of mine built this product, and it's a way to analyze not only REITs, but just any stock. They got a very large, broad universe of stocks that you could select from: Coca-Cola, whatever, Target. And this software allows you to analyze companies very quickly to determine the quality of the company, but also, what's the best price to buy the company. So it takes a little bit of time to understand, to learn that fast scratch tool, but I would definitely recommend it especially if you're interested in buying stocks, if you're a DIY or do-it-yourself investor. However, one of the reasons we built Wide Moat Research is for the investors that were really wanting somebody to do it for them. And what we do is we go and vet individual REITs, but also non-REITs and dividend stocks to really help investors build out a portfolio so they can rely on this income long term and sleep well at night. Hence the Swan portfolio is the name of what we call this product.
Gotcha. Well, let's just say someone wanted to kind of be more defensive with a REIT investment, and like, so if we asked you which REITs perform the best during a recession, like how would we go about thinking about that?
Well, I'll tell you, first of all, the sectors that don't that perform the worst in a recession first. Look out my window. There's a Marriott hotel out here, and hotels, just through any economic cycle downturn, they don't perform well. Now, I mentioned earlier, I think we're going to see a garden style recession, nothing like we saw in '08, '09. And in this type of environment, if I were going to invest in hotels, I would probably insist on limited service hotels, which is a lower price point. Um, and this would be like a Hampton Inn type of product. So there are landlords that cater to that sector, but I would kind of stay away from that sector. Um, Another challenging sector to kind of avoid. Now, retail has actually held up fairly well so far, but specifically, what I do like in retail is grocery anchored. I think that's a component that you've got to go to the grocery in any environment. It's a necessity. So there are certain shopping center REITs that focus almost exclusively on grocery anchored shopping centers. I think that's an area that I like a lot. In terms of kind of these mission critical, I call mission critical companies, I think warehousing is certainly in huge demand still and will continue to be in big demand. Again, as it relates to logistics and all of the e-commerce activities that we've seen. I think data centers, again, are also mission critical in terms of AI, but also not other stuff. I mean, just all the data that we have today that we're accumulating through our cell phones, through all the technology. I think even automated cars is another good example. Data centers are required to run automated cars. So I like data centers. I like cell towers is an interesting space. Obviously, there's the ongoing debate is to Elon Musk and his satellite technology. He's continuing to grow, but I think we're still literally light years away from any huge disruption as relates to cell towers and satellite. So I still like cell tower sector. One of the most defensive property sectors of all, believe it or not, is the manufactured housing. Now, I wanted to differentiate manufactured housing from mobile home parks. I live in South Carolina, and there's a lot of mobile home parks. Mobile home parks are older buildings. Typically, they'll be in areas where there's no like curb and gutter. You may even have like gravel in the driveway. These are very inexpensive properties. Manufactured housing is also affordable, but they're factory built. Companies like Clayton Homes, which Warren Buffett has invested in. This is really aimed more at the retiree market. You see a lot of those communities in Florida, on the coast of South Carolina, on the coast of Georgia, just all over, frankly. But they're mostly they really gravitate to the retiree. So again, the demand driver is kind of the aging population who's looking for affordable housing in markets that they enjoy a very high quality of life, but also are very inexpensive. So manufactured housing is a sector I really, really like. It's when a customer moves into a manufactured housing property, it's a very sticky customer. They stay around for a long, long time. Typically, they own the buildings, but they lease the land. So, and again, when you invest in manufactured housing, it's essentially a ground lease model, which is a very safe model. So I like manufactured housing. It is very resilient, recession proof, and performs well. I'm trying to think of any other sectors. Healthcare is also one of those sectors that's going to be around in good times or bad, no matter the economy. You have all types of ways to invest in healthcare. You can invest in senior housing. Again, that's kind of that silver tsunami I just spoke about as it relates to manufactured housing. That's your demand driver with senior housing. You need an aging population. Skilled nursing is another sector, and then you have more acute skilled nursing. You have hospitals. You can invest directly in those. Life science is another area, and of course, medical office buildings is another big sector. Again, big demand drivers. Everybody has to go to the doctor, and so there's a lot of ways you can invest in healthcare as well. And again, that's a very resilient property sector for volatile market or potentially recession.
Awesome. Well, before we wind out, Brad, I like to ask every one of my guests, what's the best and worst personal finance advice you've either heard or received?
The best advice, well, this is the advice I give, kind of all young people today is, the most important decision you're ever going to make is not your first job, it's not your first house, it's who you marry. That's think through that. Um, that's an important. That's probably the best advice. Look, I think that I also told these same college students last week. I said, look, the way to get ahead in your job is show up to your job first and stay there last and go to the office. I never thought I would tell this to anyone, but after COVID, people look at you if you're crazy if you tell them you're going to the office, but definitely go inside your office, see people, network with people, be around people. I think it's extremely important to interact with your peers and your boss and your colleagues and your customers. Now, video is great, by the way, and I'm happy to be on this show because it's great to interact with people. This is a great tool that we now have to utilize more video. But I would say, that's probably the best thing I like to tell people is to just, stay engaged. Don't just sit behind the computer. Go into work, go out to Starbucks, be around people. I think that's extremely, extremely important. And building your own network of people. I mean, sourcing is extremely important, and finding good contacts for sourcing is really critical, whether private investing or in the REIT space.
Awesome. Great advice. And Brad, why don't you tell the listeners where they can go reach out to you or learn more about your company and hear about your services?
Well, you mentioned my book. I guess I'll throw out, this is my book. You can find that on Amazon, REITs for Dummies. I'm hopefully going to do another Dummies book soon. And of course, our company is called Wide Moat Research. That's WIDE, Moat Research. Sign up for our daily newsletters called the Wide Moat letter. And we have a Wide Moat Daily that comes out every day. It's free. And take a look at that. And obviously on Twitter as well. You can see me at rbradthomas.
Awesome. We'll have links to all those. Thanks for the time, Brad.
Great. Thank you, Jack. Take care.